QuickBooks Pro Desktop 2021 Purchase of Furniture and Investment Transactions. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list. We're going to be opening up our report first, our balance sheet, to see where we start at. We're going to hit the dropdown up top in the reports, company and financial, and go on down to the balance sheet standard. I'm going to change the dates up top in the customized reports so that we have the range, so that when we drill down on the data, it will have the full range for the full year, 01/01/21, 12/31/21. Now, I typically will do the whole year here, although of course we are working in the month of January. So I'm going to say OK, and here is our information. Next transaction we're going to do is we're going to say we have some money in the checking account. We're still kind of starting the business, right? So we put money from a loan, we put money from our own investment in the business. As we consider what we're going to do to give our startup costs will include things like the purchase of furniture and fixture that we will put in place and whatnot, things that would typically start the business. Note when you're starting the business that you're doing some of these transactions are transactions that are not in the normal flow. In other words, if I go to the home page here, they're not like the custom normal vendor flow per se that we will have once the business is set up, or the customer flow. We have some deposits that don't fall into the customer flow because we're on the setup process. Once set up, then we'll have the day-to-day transactions that'll be kind of more in the standard flow type of process, and we'll get to that shortly. So if we go back to the balance sheet, then the next thing we're going to say is we want to take some of this cash and put it into an investment account. So an investment account in something like mutual funds or something like that, so that we can possibly get a return in the short term as we're holding onto the cash and using it for the growth of our business, doing things like purchasing the furniture and fixture to get the business going. So that means, what do we expect to happen when we do that? So we're taking the money out of the checking account, we're putting it into like a mutual fund or something like that, an E-Trade or a Vanguard, an investment type of account for like stocks and bonds we can imagine here. So that means the checking account is going to go down. The other side that's going to go up will be another investment account. There will be no effect on the income statement. We're just moving assets from the checking account to some other account, that being the investment account here. We're going to have to set up the investment account as we do so. Once again, if I go to the home page, it doesn't really fall into the standard flow. There's no form that lines up to that transaction because it's not one that happens on a daily basis. So then if that is not the case, we can think then that the next thing I would think is cash affected. If cash is affected, then I want to think about the cash side of the transaction, and then we can typically use the standard forms for a cash type of transaction, which could be a payment form, like a check type of form. I would typically then go to the register. So I'll go to the register and enter it. Now, if it wasn't a cash type of transaction, then I would think, is there some other balance sheet account that I can use a register for, and which would basically be kind of like a journal entry. And if not, then I go to the journal entry. So I'm going to do this with putting it into the register as we have been practicing. I think that's the fastest way to go. So you could go to the register in the home page here. You can go to the register by going to the banking dropdown and use the register. I like to go to the lists and go to the chart of accounts because I want to recognize that that register can be used not only for cash, but a similar format for all balance sheet accounts. I'm going to go double clicking on the checking account now. So here's what we had thus far. I'm going to say this transaction happens on 01/04/21. And this time I'm going to say it is a check. Now notice you can put transactions into this check register that are not checks, meaning if you had an electronic transfer. If, for example, you are taking all your checks from the bank statement and you're entering them in here and they were electronic transfers, I would just delete the check number or put something other than the check number, like electronic, or something that stands for electronic transfer, so that when you write the checks that you will only have the check number. Many companies don't write a lot of checks right now, and that's fine. Also note that when you do write the check, you want your check numbers to be lining up to the checkbook or the checks that you're putting into the system. So there's two ways that you can write checks, basically. One, you can actually print the checks through QuickBooks, but QuickBooks cannot just print a check on a blank piece of paper because that's not a good internal control. You still have to buy the checks, which will have pre-numbered numbers on them, which you will then put into the printer and print the number, and then the number in QuickBooks should line up to the number that's actually on the pre-printed check. So you still have to buy the checks from the bank. Or you can just simply, if you don't write many checks and you don't want to print them out of QuickBooks, but simply manually handwrite them because you don't have a lot of them, and then manually input them into QuickBooks so that they will be populated on the financial statements, then you can just type in the number. That's kind of the practice we will do here. So I'm going to say this is going to be check number 1001. And so I'm going to imagine we're writing the check, or, and it's lining up. This is the first check in the checkbook, which I'm going to say is 1001. And it'll line up here. And then we're going to say that we're going to be paying, let's say, Vanguard, ARD. This is going to be a type of investments company for mutual funds. I'm going to say tab. And I'm going to quickly add it up. I'm not going to do the advanced setup. I just want the name of Vanguard. I don't really need their contact information. Once again, this is like a bank, so it's not really a vendor or customer or employee. So I'll put it into other. And this is going to be a payment. So we're taking money out of the checking account. It's going to be $12,000. So we're saying $12,000 out of the checking account. Then where's the other side going to go? I have to set up a new account because this is going to be an investment account. It should be up here in the assets section. There's nothing up here in the assets for an investment. So I'm going to say, all right, let's add a new one. I could say new here, or I could just type in the name of the account. And this is kind of like a double check to type it in here, because if I start typing in short term, and that's kind of a double check because it's starting to populate the accounts that line up. So if I type it in here and it's already there, then I was like, oh, I don't need to add it. It's already there. So I'm going to start short term investment. So there we have it, and then I'm going to say tab, and it's going to ask me, do you want to set it up? This isn't an account. Do you want to set it up? I'm going to say yes, let's set it up. The default when you're in the register will typically be the expenses, because many times when you write a check, it's going to go to the expense. So this time we're not decreasing the cash to go to the expense, but to create another asset account, which is going to be an other asset, and I'm going to put it into other current assets. So that's going to be an other current asset account. That's all we need. It's not a sub account or anything like that. No opening balance. And then we're going to say save, and there we have it. And then you could say, this is for short-term investments. All right, that we're going to put in there, and tab, and there we have it. Now I'm going to then go back to the balance sheet. If we go to the balance sheet, then we now see in the checking account, if I double click on the checking account, we're going to say there's the decrease of the 12,000. That looks proper. It looks good. Closing that out. The other side is going to be in the short-term investments. Double clicking on the short-term investments. There's the item in the short-term investments. If I double click on that item, I'm going to go to an actual check form. So notice it's in the form of a check here, even though we entered it into the register. So this is the form that you would use even though you entered it into the register. This is important to kind of note if you're using bank feeds as well. So if you download these transactions from the bank, what's going to happen on the bank feeds, you'll download the transactions, but then you'll have to add them to the system. And you got to get a feel for what forms are going to be driving these things so that you can assign the forms out as you assign the bank feed types of transactions. And that's what you want to get a feel for and actually practice your accounting, the flow of the accounting process, so that you can then know what forms are going to be used. And then if you do the bank feeds, you'll know how that will work as well. So I'm going to close this back out. There's going to be no effect on the income statement because this was strictly a balance sheet transaction. All right, the next thing we're going to do is say we're going to purchase equipment. So we're going to purchase equipment. We're going to practice purchasing just for cash at this point in time. So we're going to be paying cash because we put all this cash into the business so that we can start up our purchasing of what we need to run it. That's going to include oftentimes machinery and equipment. So we're just going to put it into the furniture and equipment account. We already have the furniture and equipment set up. Notice that oftentimes when you make a large purchase like equipment or machinery or something like that, you might finance it. We'll talk about financing later. In the second month, we'll do more transactions that have like financing and things like that. In this month, we're going to do more of the cash type of transactions. Therefore, we're going to just simply write a check for a fairly large transaction, that being the furniture and the fixture. Now note, we already have an account set up for furniture and equipment. So if that's an account that we want to use, we can keep that name, or we can basically adjust that name if we don't want that name that was provided by QuickBooks, or we might have multiple different furniture or fixed asset, property, plant, and equipment type of accounts that we could set up, like building, equipment, and then furniture, breaking those asset accounts out. You might want to talk to your accounting firm to help to do that, because the accounting firm might be doing your taxes, and they're going to have to enter that information oftentimes into the tax software in order to help out with that calculation for the tax side of things. And as they do that, they can often help out with the calculation of, say, accumulated depreciation, the adjusting entry that we'll do at the end of the month. So it's often good to line your books up to what the tax software, if you're going to be adjusting the detail of your property, plants, and equipment in tax software, it's often good to line up your categories to the categories that will be there on your tax software. So I would talk to your, accountant or tax preparer to help with that categorization. When we buy the equipment, note that we're going to move away. Even if you're like a cash basis person, you like a cash basis system, this is one area where we pretty much have to move away from a cash basis system. We're going to be paying cash for furniture and equipment, but if we expense it at this point in time, it will cause the income statement to have this huge expense on it that's really going to be benefiting multiple time periods into the future. And therefore, we will typically, even if using a cash basis, put the furniture and equipment on the books because it is a large purchase as an asset. And then we will expense it in the format of depreciation over the useful life of the property. So that's going to be our concept. So we're going to do the same process here. I'm going to go to the checking account. So it's in our open windows. I think that's the easiest way to enter this data input. So we're going to say 0109, let's say 21. And notice that it's now populating the second check number. So if we're using a check, then this number should line up to either the physical check that we are writing or should line up to the check that we need to have printed. So we would then have the check 1002. If you're paying with something other than a check, say it's an electronic transfer, say you're taking this information from your bank statement or something like that, then you want to delete the check number and put something else to indicate it there, or leave it blank. And so then we're going to say this is going to be, I'm going to say Office Depot, and that's going to be our vendor. I'm going to say tab, and I'm going to quickly add it. I'm not going to set up all the detail. I just want a quick add, and this one is going to be a vendor because this is who we are purchasing from. Everybody we purchase from is going to be a vendor. So I'm going to say vendor, and then I'm going to say this is going to be 16,000. We'll say that's how much we're going to be purchasing for the furniture and equipment. Drop down. This should not be an expense account, but an asset type of account, and more specifically, a fixed asset type of account, or sometimes called depreciable asset, property, plant, and equipment, PP and E. It's all different names for pretty much the same things. So we're going to say the furniture and equipment. That's what they named it here. And then you might want to, of course, put some more detail on the furniture and equipment that you have purchased. I won't here, but you might want to put more information in the memo. Any furniture and equipment that you will purchase, you want to make sure to hold on to the detail of it so that you can provide that detail to your tax preparer at the end of the year, and they can hopefully help you out to obviously do the taxes, which will require depreciation on it on a tax basis. And they may be able to help you out with the calculation of the depreciation on a book basis as well, so that you can do that adjusting entry. So I'm going to say enter. So there we have that, the 16,000, decreasing the checking account. If I go back to the balance sheet, then we're going to say, all right, let's double check the checking account, double click the checking account. There's the Office Depot. If I double click on that, we see that now it's a check form. So we see the check form that is generated, even though we entered it into the check register, closing this back out. Closing this back out, the other side is going to be going into furniture and fixture. Double clicking the furniture and fixture. There's the 16,000 again. Closing this out. Now at the end of the year, you're going to have to record the expense related to it. That'll be depreciation. Again, you might get that. You might be able to get that adjusting entry through the tax software that might be helped to do that from your tax preparation. Whoever's doing your taxes might help you to do that adjusting entry at the end of the period, but you will have to provide them with not just the total amount of the furniture and fixture, but the description of what you purchased, and you probably want to be as detailed as possible so you can line that out. So when you sell it, it'll be as easy to sell to figure the gain or loss on the sales side of things. All right, we'll do it again. So we're going to imagine we're just going to purchase another piece of furniture and fixture. This time, let's just actually look at the form. So I'm going to go to the home page, You could enter it into the register again, same thing. You'll note that it was generating a form. The form being generated is this print checks form. So I'm going to go into the write checks. So here's going to be the form that we're going to be using. I'm going to say that this is going to be coming from the checking account. Let's just tab through this, which will be typically, of course, standardly the case. This is going to be as of 011121, 011121. I'm going to say this is Amazon. We're going to purchase one. We're going to quickly add it again. So I'm going to use a quick add to add the Amazon. I'm going to keep it as a vendor. Note that when you're using something like generic, like Home Depot or Amazon, sometimes you may actually want to adjust the name for small purchases versus large purchases or something like that, so that when you go into Amazon, it'll memorize the correct account. So for example, this one, I'm going into Amazon for large purchases. So you might want to actually indicate Amazon, some indication that's a large purchase that will distinguish the vendor from small purchases. And when you do that, you can then have the accounts will start to memorize the accounts down here when you record the transaction. And then it might be a little bit easier to line up the same transaction instead of having the same exact vendor name that goes to different expense accounts. You could try to differentiate the vendor name a little bit so that you can have different vendor names, and then the proper expense account will just populate automatically. In other words, once I choose the vendor in the second month, the expense account that we used in the prior month will automatically populate based on the prior data. And that's going to help us to be more consistent. That's what we'll see in month 2. So we'll see that QuickBooks will try to help us out. In month 1, we have to make up a new account every time we have a vendor. We got to say, okay, which account does it need to go to? Make sure it goes to the right account. In month 2, then QuickBooks will start to memorize the vendors for us, and that data input process will be a little bit easier. If you have a vendor that's very broad, that you have multiple categories of expenses for, you might think of a way to vary the vendor name just slightly so that you can have different vendors that will then be linked to the proper expense accounts so that you can record things a bit more quickly possibly. So I'm going to say this is going to be 7,000, and this is going to go to the furniture and fixture. Once again, an asset account, not an expense account. So I'm going to go into the furniture and fixture up top. Probably do want a memo here. I'm not going to put a memo in the example, but it's typically a good idea to do so if you have a memo. So I'm going to say save and new, and then I'm going to close it. And then let's go back to the balance sheet, see what happened. Back to the balance sheet, double click in the checking account. We see there's the 7,000, double click in the 7,000. Now we entered it in the same kind of form that we would typically use for a decrease in the checking account. In other words, almost all the time, most of the time, when there's a decrease in the checking account, we will see this type of form or variant of it, like a bill pay type form, which is basically the same kind of thing. So I'm going to close this out. And then the other side is going to be in the furniture and fixture. So there we have our 7,000. So we've increased that. And so closing this out, and now let's open the income statement. There should be nothing on the income statement. So this is going to go to the company and financial profit and loss. I'm going to change the dates from 01/01/21 to 12/31/21. And notice there's nothing on the income statement. And that's because, we purchased something, although we're going to use it in the business and we're going to expense it. We can't expense it in the point of purchase because it was too big. It was too big a thing. So we have to put it on the books as an asset and then depreciate it. So we will have expenses related to those items, but they will be in the format of depreciation. And once again, I would recommend using outside software such as the tax software and possibly lining up to tax depreciation if you're a small business, or seeing if the software can help you to break out tax and book depreciation for a larger business and then do the adjusting entries on a periodic basis, either monthly, quarterly, or yearly, to record the depreciation expense. Let's then take a look at the trial. Let's go back to the balance sheet. This is where the balance sheet stands at this point in time. So you can just check it out if you're following along. If you want to see it a little bit more easily or in a smaller format, let's look at the trial balance. So I'm going to go on down to the trial balance so we can take a look at that. So let's change the dates from 01/01/20 to 12/31/21, and there's the trial balance. Now I'll try to save the trial balance after each time period and provide that so you can kind of line up and check your numbers to what we have in the trial balance.